The rules for inheriting an IRA are incredibly tricky and complicated. The role of this video is to make them as easy as possible to understand. My name is Erik Goodge. I am a chartered financial analyst and a certified financial planner and the owner of Roth Advisory. Let's jump into it. To understand your responsibilities if you inherit an IRA, you first have to understand required minimum distributions, or RMDs for short. Required minimum distributions, or RMDs, are distributions that you must take if you own an IRA or if you inherit an IRA. These are taxable distributions. If you are the owner of an IRA, they must begin by April 1st of the year following the year in which you turn 73. Now, these rules are actually changing. So if you're born in 1960 or later, your required beginning date is actually April 1st of the year following the year in which you turn 75. In all subsequent years, required minimum distributions are due by December 31st. But if you wait until April 1st for that first distribution, then you'll have to take two distributions that next year. You'll have to take one on April 1st, and then you'll have to take your second required minimum distribution for the year in which you're 74 by December 31st. And it's important to note that required minimum distributions apply to those who inherit IRAs just like they apply to the owners of IRAs, although the way we calculate those minimum distributions differ slightly, and I'll show you how those distributions are calculated. To understand your obligations if you inherit an IRA, you first need to understand what type of beneficiary you are. There are two types of beneficiaries: eligible designated beneficiaries and designated beneficiaries. Eligible designated beneficiaries are spouses, minor children of the IRA owner, chronically ill or disabled individuals, or any beneficiary that's not more than 10 years younger than the original IRA owner. Those four categories are all eligible designated beneficiaries. Now, everybody else is a non-eligible designated beneficiary, or simply designated beneficiary. And for the purposes of this video, we're going to ignore situations in which an entity is the beneficiary of an IRA and just focus on situations in which individuals or people are the beneficiaries of an IRA. Now, there are two possible scenarios that can play out if you are an eligible or non-eligible designated beneficiary. You can inherit an IRA when the owner was already taking their minimum distributions, or you can inherit an IRA before the original owner was taking their minimum distributions. And your obligations differ under these two scenarios. But the nice thing is that this creates a nice 2x2 matrix that we can walk through to figure out what our obligations are. So let's start in the upper left-hand quadrant. In this quadrant, we are going to focus on eligible designated beneficiaries who are inheriting an IRA before the original owner was required to take minimum distributions. In this situation, there are two main options. You can apply what are known as the stretch IRA rules, and these rules require that you take distributions each year according to your own life expectancy, and the distributions are required to begin in the year following the year in which the original owner passed away. The account values on which the distributions are calculated is the account balance on December 31st of the prior year. The second option for an eligible designated beneficiary inheriting an account before the original owner was taking minimum distributions is to apply the 10-year rule. Now, I will explain the 10-year rule a little bit later, but suffice it to say that in this situation, it's typically not as tax efficient to apply this rule, although you would, of course, want to talk to your individual tax advisor for your particular situation. Now, if you're a spouse, which is one of the categories that qualifies as an eligible designated beneficiary, you actually have two bonus options here. You can roll the IRA into your own IRA and treat the account as if it were your own, or you can wait until the original account owner would have been RMD age and begin taking RMDs then. So let's take a look at the lower left-hand quadrant and see what your obligations are if you are an eligible designated beneficiary and you are inheriting an account after the original owner was required to take minimum distributions. In this situation, you are obligated to apply the stretch IRA rules that we talked about in the first scenario. To recap, those rules say that you must begin taking minimum distributions in the year following the year in which the original owner died. And those distributions are based on your life expectancy and the account balance on December 31st of the prior year. And also, like the first situation, if you're a spouse, you have one bonus option here, and that is to roll the IRA into your own IRA and treat it as if it were your own. In general, if you are a spouse, you are automatically an eligible designated beneficiary and you will always have this option. So let's take a look at the upper right-hand quadrant and talk about non-eligible designated beneficiaries, or simply designated beneficiaries, who are inheriting an account before the original owner was taking minimum distributions. In this situation, you will have to apply what's called the 10-year rule. And this rule states that you must fully distribute the IRA within 10 years following the year in which the original owner passed away. You are not required to take minimum distributions in years 1 through 9, which is nice. But if you wait until year 10 to take the full distribution, you could have an increased tax impact because you are compressing the tax burden into a single year. You can take distributions in years 1 through 9. You are just not required. And there's no maximum amount that you can take in any given year. You can take as much or as little as you like. Your only obligation is that you fully distribute the account by the 10th year following the year in which the original owner passed away. Now let's talk about our last situation. And these are non-eligible designated beneficiaries, or designated beneficiaries, who are inheriting an IRA after the original owner was required to take minimum distributions. In this scenario, you are also going to be following the 10-year rule, but with a twist. Here, you are going to be required to take minimum distributions in years 1 through 9 before fully distributing the account in year 10. The minimum distributions are again based on your life expectancy, and they're based on the account value on December 31st of the prior year. The first distribution, again, does not need to happen until the year following the year in which the original account owner died. It's also important to note that there is no maximum distribution in any given year. There is simply a minimum distribution that you must take in years 1 through 9. And in year 10, the account must be fully distributed. So we can see that the 10-year rule is quite a bit less flexible than the stretch IRA rules. The stretch IRA rules, as a reminder, apply to eligible designated beneficiaries, and the 10-year rule applies to designated beneficiaries. This is because you're compressing the tax burden into a 10-year window, and there's no real right way to handle this. What you have to do is consider what your marginal tax brackets are going to be in that 10-year window. For example, we can imagine a situation where over the next 10 years, you anticipate your income dropping substantially. And if that's the case, then it might make sense to hold off taking any distributions if you are allowed to. That is, if you are a designated beneficiary inheriting an account before the original owner was taking minimum distributions, it might make sense to hold off on taking any of those distributions until later in that 10-year window. Because if your income is going to drop, then you are likely to be in a lower marginal tax bracket, and you can use that distribution in later years to fill up those lower marginal tax brackets, which is relatively more beneficial than if you take distributions now when you're in a higher marginal tax bracket. Again, there's no real right answer here. You just need to consider your particular situation and what your income is going to look like over the next 10 years. And it's also important to consider the quote-unquote year of death RMD, because this has caused a lot of confusion. You can imagine a situation in which the original owner was required to take minimum distributions, but they passed away before they had the chance to take their last minimum distribution. Now, the responsibility to take that last distribution falls to the beneficiary. And they must take that distribution in addition to any distributions they're required to take as a beneficiary. For example, if they're following the stretch IRA rules, or if they're required to under the 10-year rule. And it used to be the case that they had to satisfy the owner's last distribution by December 31st in the year that the owner passed away. This caused a lot of problems because you can imagine that an owner who dies on December 31st does not leave their beneficiaries a lot of time to satisfy their final minimum distribution. New IRS guidance states that the beneficiaries have until 1 year following the year in which the original owner passed away to satisfy that owner's minimum distribution. And it bears repeating that if you must satisfy the original owner's final minimum distribution, that does not satisfy your minimum distribution as a beneficiary under either the stretch IRA rules or the 10-year rule. Those distributions must happen as well. I also want to mention that if an owner dies after they turn 73, but before their required beginning date, recall that our required beginning date is April 1st of the year following the year in which you turn 73. If, for example, somebody turns 73 in September and they pass away in January, the IRS will consider that person to have passed away before they were required to take minimum distributions. Let's now also talk about situations in which there are multiple beneficiaries. If there are multiple beneficiaries, each individual beneficiary may or may not, depending on the rules that apply to them, have their own minimum distributions. So, for example, if we have 3 siblings and they are required to follow the 10-year rule with minimum distributions in years 1 through 9, each sibling will have to make a minimum distribution in years 1 through 9. However, if the siblings are also required to satisfy the owner's final minimum distribution, they can split that up any way they like. The IRS doesn't care if one sibling satisfies the owner's final distribution or if all 3 split the owner's final distribution. The IRS simply cares that the final minimum distribution was satisfied, and that will be based on the account value as of December 31st prior to the year in which the original owner died, because that is the account value that the owner would have been basing their own minimum distribution on. And finally, before we take a look at how we calculate these minimum distributions, I want to talk about inherited Roth IRAs, because this is actually kind of tricky. If you are an eligible designated beneficiary and you inherit a Roth IRA and you're applying the stretch IRA rules, you are required to continue taking required minimum distributions. Again, these distributions begin in the year following the year in which the original owner died. But since Roth IRAs are after-tax accounts, these distributions are likely tax-free. A scenario in which they wouldn't be tax-free is if the 5-year rule for the tax-free distribution of earnings had not been satisfied. As a quick aside, that rule states that 5 years must have passed from January 1st of the first year in which you contributed to a Roth IRA till present for earnings to be distributed tax-free. So as long as that 5-year rule has been satisfied, if you are required to make minimum distributions following the stretch IRA rules in a Roth, those distributions will be tax-free. Now that is for the stretch IRA rules, and the stretch IRA rules only apply to eligible designated beneficiaries. If you're a designated beneficiary and you inherit a Roth IRA, you are going to be following the 10-year rule, but in no situation will you be required to make minimum distributions in years 1 through 9. And this is because with Roth IRAs, the original owner never reaches an age in which they are required to take minimum distributions. And so therefore, the designated beneficiaries will never be required to take minimum distributions. However, they still will be required to fully distribute the account by the end of the 10th year following the year in which the original owner passed away. And this makes Roth IRAs a lot nicer to inherit than traditional IRAs because there usually is little to no tax burden in those distributions. Now let's take a look at how these minimum distributions are actually calculated. Okay, to calculate these RMDs, you're going to go to IRS publication 590B, which is the governing publication for all distributions from IRAs. And I don't encourage you to try to calculate these on your own. Definitely talk with a CPA or an advisor if you can, if you have access to that resource. But it is good to know in principle how they are calculated to give you a better idea of where these RMDs come from. We are going to scroll down here to the appendix and then scroll down to Appendix B, life expectancy tables, and this is table 1. This is for beneficiaries. So the way we calculate these are actually kind of tricky. If you are not the original owner or you are not a spouse, but you are a beneficiary, anybody else who's a beneficiary, and you're required to take minimum distributions, the way you're going to calculate these is you're going to find your age and then find the factor that's associated with your age. So if you're 25, for example, that factor is 60.2. You're going to divide the account balance of the account you have inherited as of December 31st of the prior year by this factor. And that's going to give you your first year's required minimum distribution. Now, in subsequent years, you are going to subtract 1 from this number in all subsequent years. You're not going to, for example, when you turn 26, use this factor, although you actually will be using this factor because you're subtracting 1 from 60.2. But you wouldn't continue to find your age on this table after that first year and use that associated factor. Because eventually it's not going to be a -1 difference. You can see here between 27 and 28, it's like a minus 0.9 difference. But in any case, you are going to find your age, the associated factor, and then in subsequent years, subtract 1 from that factor. So when you're 25, you'll divide your account balance by 60.2. When you're 26, it'll be 59.2. When you're 27, it'll be 58.2. When you're 28, it'll be 57.2. Notice not 57.3, but 57.2. Okay. If you are a spouse, recall that you can treat the IRA as your own. You can roll it over to your own account, in which case you wouldn't be taking RMDs until your RMD age, or you could apply the stretch IRA rules. In either of those cases, though, the way you calculate your RMDs are a little bit different. Instead of using the -1 method like we did earlier with age 25, we subtracted 1 from 60.2 each subsequent year. Instead of doing that, you're actually going to find the factor associated with your age each year. So let's say you're 50 and you're doing the stretch IRA rules and you're a spouse. Your first RMD is going to be based on 36.2, that factor, because it's associated with age 50. Then we'll go to age 51 and we'll see that it's 35.3, 52, 35.4. 53, 33.4. So in general, if you are a spouse, you're going to be recalculating your RMD each year based off this new factor. The same goes for the original owners of IRAs. Recall that there are cases in which you must take the original owner's final RMD, and that is going to be based on the account balance as of December 31st of the year prior to the year in which they passed away, because that's the account balance that their RMD would have been based on. For original owners, though, we are not going to use Table 1. We're either going to be using Table 2 or much more likely Table 3. Table 2, by the way, is for use by people whose spouses are their sole beneficiary and more than 10 years younger than they are. So it's a sort of a unique situation. But Table 3 is the most common, and we're going to scroll way down here to find Table 3. And we can see here, for example, if the original owner was 75 when they passed away, you are going to be using the factor associated with age 75. Now, if you are the original owner and you are watching this video out of curiosity and you're just curious how you calculate your own RMDs, you are going to calculate this in a manner similar to the way spouses calculate their beneficiary RMDs. And that is going to be that each year you're going to be using a new factor. So 77, you'd use 22.9, 78, 22. You wouldn't use the -1 method that we talked about earlier. But that is how you calculate these RMDs. Again, if you're the original owner or you're calculating the RMD for the original owner, you're most likely using Table 3 here. And everybody else, beneficiaries, all of the beneficiaries are using Table 1. I hope you found this video useful in deciphering your obligations if you inherit an IRA. Let me know what you think in the comments. Again, my name is Erik Goodge. I'm a chartered financial analyst, a certified financial planner, the owner of UVest Advisory, and I'll see you next time.